Hello, everybody. Happy Easter. Welcome to the stream. Welcome to this week, and what a week it has been. We certainly have a little bit of news. We'll talk about that as we go along, and we'll see what you guys are all up to. Hopefully, bring your conversation because it wasn't a super busy news week. So I have a feeling we'll run out of the news pretty darn quick. But nonetheless, we still have some. Um, Before I jump into the chat, just want to very quickly thank everybody who watches this on the replay because about 75% of the views come from that replay. And I certainly appreciate you guys. Feel free if you've got questions, comments when you're watching the replay, put them in the comments. I will answer them just like I would with a video. So that'll be really, really good. All right, now let's jump in here to the chat. And chat, let me know if I am too low today because I was playing with the mic a little bit and I actually changed a couple settings on it just to see if I could eliminate a lot of the background noise. That's kind of where I was aiming for. All right, we got covered call ETF investing in the house. Now, he has a wonderful little channel. It's a brand new channel. It's just growing. And, well, he talks all about covered call ETFs. I know a lot of you guys love those covered call ETFs. So you may want to check out covered call ETF investing because it might just be right up your alley. Perfect. We have Richard MTL. And now MTL, is that because you're from Montreal, I assume, Richard? I'm thinking. We got Jill in the house. Hello, Jill. Looks good to me. All right. Well, we're talking about the sound. The sound is mostly what we're looking at because I did change some settings on the microphone. All right. And we have Ciso99 in the house. And yes, you're from Montreal. All right, awesome. You're not very far from me, to be honest. I'm in Ottawa, so you know it's just a hop, skip, and a jump to get over there to Montreal. And Cisco just got back from Florida. Holy banana bread, Cisco! That's fantastic. Oh, I'm not supposed to say fantastic so much, so that's great. You're getting back just in time for spring. Now, if you, I don't know where you're at exactly, Ciso, but I know here in Ottawa, next week we've got like, holy cow, we've got like 4 days in a row where we're going to have a humididex. That is just absolutely fantastic. So I'm looking really interested. I'm looking forward to that because there's still a pile of snow in the backyard that I want to see it melted away. And then, you know, next year it can come back. So we will see that. Let's see. My friend works for the CRA in Ottawa. Well, let's hope your friend is not going to be on strike soon because I know the CRA is they're talking about that. And let's see. Oh, covered call says my son Bryce is watching this with me. Shout out to Bryce. All right. Hey, Bryce. I'm glad to see that you're watching here with your papa. He's got himself a fantastic channel. You've got a great dad because he knows about investing and he's going to make sure that you're on the right foot so that way there you'll make tons of money when you become an adult. Now, if Bryce is actually already an adult, this is really embarrassing, but I don't think he is. But I still had to say that anyway. All right, let me jump over and quickly grab you guys the first story of the day. Just give me a second here. I have a sheet that I keep like in point form. I just keep all my stories, and I pulled up the absolute wrong sheet. There we go. He's 6 years old. Okay, that makes sense. All right. Bryce, you rock. 6 years old and you're watching stuff on finance and business news? Holy banana bread. You're an awesome kid. All right. So our top story, of course, is wanted to talk a little bit about Apple. So Apple, as we've talked before, we talked before that they're starting to move a lot of their factories over to India. Part of it is they don't want to rely so much on China because in a way, when China had all of these lockdowns and shutdowns, a lot of Apple's production was pretty much well, it was impacted big time. You know, lucky for them, I guess, there wasn't a big demand where people have been cutting back spending. But they are looking towards a few different places. India is one of the big ones. Now, India has now become the most populous country on the world. They have surpassed China, which is amazing. And they also have one of the world's fastest growing economies. So Apple's looking at this from two different ways. One, of course, they're thinking there's a lot of people in India. We can get some of our factories up and running, and that's what they have been doing. So their plans are this year is to make 10 million iPhones in India, and they would love to see by 2025 they want to see 25% of all iPhones being made in India. So that's huge. The other interesting thing too is India can also, not just the iPhones, they can also make, for example, AirPods, Apple Pencils, and some of the components for the Apple Watch, iPads, as well as the Mac computers as well. So there's a lot going on with that. Now, in addition to that, just to sort of put this out there, Apple is also opening up their first retail. They have 2 stores they're planning to open, but their first store is about to open. I believe it's this week. And that's kind of huge because they're going to be able to move a lot of product in India. There's a huge demand for Apple products in India. And especially with India, people are starting to make money in India with that economy growing as fast as it is. So that's a good move for Apple. Now, in addition, of course, to India, Apple is also looking to set up some manufacturing in Vietnam, Malaysia, and Ireland. So we're going to have a little bit of stuff. Now, they're not going to completely move out of China. One big reason they don't want to move out of China is the fact that a lot of their competitors don't have a presence in China, and Apple doesn't want to get rid of that. I think more or less this is Apple spreading their eggs out of different baskets. So, if we run into a situation kind of like what we did before, so that's going to be kind of interesting. And good move for the iPhone. Get out of China. Yeah, absolutely. And we got Sammer in the house. Good afternoon, all of you guys. It's always fantastic. It's one of these funny things is that when I do a live stream on a holiday, I'm always thinking, oh, everybody's going to be too busy to be going to a live stream, not on a holiday. But lo and behold, one of my most popular live streams ever was a Christmas Day one that I did, not last Christmas, but the Christmas before that, I did a Christmas Day live stream. I expected almost nobody to show up. I brought a lot of content because I thought I would be talking for an hour straight and have nobody in the thing. But no, it was actually pretty busy and it was actually pretty hopping, which was absolutely fantastic. Which was absolutely wonderful. All right. Now, the next story that I do have is on the Canadian jobs market. This sort of ties into where is the Bank of Canada's heads going to be when we come to this week. I believe it's Wednesday. That's when they're going to announce whether or not there's going to be a rate hike. So here's the things that sort of work against it. One of the things they want to do is they do want to see jobs come down, but it's not happening. So in March, Canada added 35,000 jobs, and that's despite the higher interest rates. And it's also, we've also got like record low unemployment. So it's amazing the situation that we're in. Now, there were gains and there were losses. On the gain side, transportation, warehousing, business, building and other support services, finance, real estate, and rental and leasing. So a lot of job gains in those sectors. Losses actually came, and this is really interesting. Construction had losses, but I think that's more of a bit of a supply chain, and that people and also I think people are not building. People are trying to conserve money. So that could be part of it. Also, Natural resources had a little bit of a drop. So that's kind of interesting because I know I'm bullish on Canada's natural resource sector. I know there's a lot of money coming into that sector. So that one was surprising. I will absolutely say that. Now, here's another interesting thing that sort of ties into this. So Statistics Canada said that the population in March, the population of Canada grew by 0.3%. And unemployment, it only rose by 0.2%. So that's kind of those aren't too big a numbers difference, but part of it does show that we've got a lot of immigration that's coming in, and that in itself is also helping to create jobs. So there's a whole big cycle that's going on. Now, April 12th, so Wednesday, that's when the Bank of Canada is going to decide what they're going to be doing. And now, even though they want to see the jobs start to cool down, one of the things you have to realize is that jobs are one of these things that have a bit of a leg to it. So when you're raising the interest rates, it doesn't affect the jobs immediately. It takes a little bit of time. We've already seen an effect on inflation. So inflation's been coming down, which is fantastic, which is great. And we're starting to see that. And that seems to be forming a trend, a really good trend. So I think in this case, I think the Bank of Canada, when it comes to their meeting on on Wednesday, I think it's going to be a no-go. I think they're going to keep the 4.5 where it's at. I don't think we'll see a hike at all, which is great. So that's going to be really interesting. So that's going to be Wednesday for us, the good old Bank of Canada. All right. And Alan says, good day to all. Sun and warm temperatures in southern Alberta. Absolutely. Southern Alberta, for those of you who have never been in Alberta, the best part about southern Alberta, especially if you live like in like Lethbridge or or Calgary, for example, is even in the middle of winter, you get these Chinooks. Now, a Chinook, it's actually a native word that means snow eater. And the reason they call it that is it's basically a wind that comes over the mountains, so over the Rockies. And the friction between the mountains and that wind warms that wind up. So they get this warm wind that blows in the middle of winter. So you can go from a minus 30 day and a Chinook can blow in and it can be plus 5 in an hour. It's that drastic when it comes in. So a lot of times, I know when I lived in Calgary, all of the side streets in the winter, they never bothered really plowing them. So sometimes they would get pretty janky. But the reason they didn't plow them is they always knew that a Chinook would be by probably within a week or so and would melt all of that up. So that's kind of a neat thing about Alberta. Other fun fact about southern Alberta is if you go to the city of Vulcan, which is south of Calgary, in the middle of the city of Vulcan, they actually have a Starship Enterprise, like from the first original one, in the middle of the town. It's really kind of a tourist attraction, but anyway, that's that's our Alberta trivia for the day. Muggsy is in the house and says it's balmy in northern Ontario. Nice. I know. And this is the thing. This stuff moves from west to east. So I imagine most of Ontario is already starting to feel all the warmth that we're going to start getting tomorrow, and especially going into Wednesday and Thursday. Kind of a neat little thing. Holy banana bread. Okay, let's actually, before we jump to some more news, want to talk a tiny bit. I mentioned last week about Blossom. So Blossom, by the way, guys, is a social media app for Canadian investors. That's the best way to say it. Now, I do have a link down below in my extra info that, it doesn't cost you anything to sign up. You don't even have to hook up your, like I've hooked up my account so you guys can see what I'm doing, but you don't have to do that. I mean, if you want to just, download the app and come in and, chat away and talk, it's a great way because it gives you a bit more chance to sort of communicate with myself, with people who are like-minded. It's just a fantastic way, I think, to connect within that Canadian environment. And it's not all muddled up because, a lot of times, like you go on Twitter and that, and you've got everybody and their dog there. Blossom's a little bit different. Blossom just tends to be a very friendly community. So I love it over there. So anyway, just grab that link down below. download the thing on your phone or your iPad. I use it on my iPad. And then, you can sort of go over there and have fun. And I do stuff over there. I put polls and stuff like that as well and answer questions and all of that fun stuff. So anyway, I hope to see you guys over there. Once you guys do that, make sure you follow me. I'll follow you right back. And we'll talk on Blossom as well. All right. Now Richard says, Kiera looks like a good Canadian company with good dividends and ideal for my TFSA. Yes, I'm very bullish on oil for this year. I was bullish coming into this year, but then the oil industry kind of went down a little bit. But now we've got, if you look at all of the Middle Eastern countries right now, they're pretty much suppressed their oil. We'll add Russia to that list as well. Between all of those countries, they've suppressed about 1.9 million. I think it's 1.9 million barrels a day. It's a crazy amount that it has been suppressed. So oil's been sort of creeping up slowly. I'm actually really, really surprised. I expected to see oil move up a lot more than it already has. So I think oil's one of these ones to watch. And I think if you're throwing something, Richard, in your case, if you're throwing Kiera into your TFSA, that's probably not a bad buy. There's a lot of different good companies, I think, out there. I know last Thursday I did a deep dive on Canadian Natural Resources. They're a great one. I also like Tollerene. That's that company. If I have the name in front of me, I can pronounce it perfectly every single time. Torlamine. But if I'm pulling it from my head, sometimes it comes out in really funny ways. All right. Covered Call ETF Investing says, James Thorne from the World Outlook Conference in Vancouver in February predicted rapid deflation later this year. The trend seems to have legs. Any opinions on rapid deflations? Here's the thing. There's a few different causes of inflation. And one of those causes, of course, has been the supply chain issues. Those are ones that are going to basically turn themselves around all on their own. So we will get a certain level of deflation from that. Whether or not that's going to be big enough, it really boils down to how much of this inflation has been 100% supply chain. So I think once we see, and there's going to be two things. And the other part too is, remember that leg when it comes to the jobs. We're going to see jobs start to sort of peter down. You're not going to have that huge availability of jobs as we move into the second half of the year. So that as well is going to sort of help prevent wages from going up, which will make it harder for businesses to pass on some of these extra expenses to the consumers. So I think that's going to be really interesting. Will we see deflation? There'll be a certain level of deflation, but will that deflation be enough that it won't just look like inflation slowing down? That's a good question. I don't yet subscribe to it, but I'm open to it, if that makes any sense. All right. And Jay says, hey, everybody, can't wait to get my tax return back and buy 4 CNR stocks. Oh, CNR. Jay, love CNR. CNR is one of those recession-proof stocks. They're also pretty darn good. When the economy is looking great, you can look at your CNR and you may look at the dividend and say, oh gosh, it's like 2 point something percent. But you get a lot of growth in CNR when times are good. And even when recessions are running, CNR, because it's essential to the supply chain, it's one of those stocks that you're not going to see drop 20, 30%. It's going to do much better and it's going to outperform the market in bad times. And good times, it does pretty good too. I know the last bull market, my total return on CNR was around 20 to 24%. I can't remember the exact number, but a lot better than a high dividend stock when you look at it from that perspective. So definitely a good choice, Jay. Get those CNR stocks. And Jordan is in the house. Hello, Candace and chat family. Hello, Jordan. It is fantastic to see you again. And that's a funny thing. Like I said, just before this chat began, Jill's like, Try not to say fantastic so much. I'm absolutely failing at that. So that's kind of funny. But anyway, we'll keep this here moving. All right, let's see what we got up next. Our next little story is all about downtown offices right now in Canada. So downtown offices are starting to look a little bit like ghost towns in many places. So right now, and this is really interesting, Canada's downtown office vacancy rate is sitting at 19%. That's huge. That's 19%.
Could you try again?
Hi, Siri. So Siri wanted to tell you that she didn't get that. But yeah, so sitting at 19%, that there is almost double compared to the where it was at before the pandemic. Now, in Toronto and Vancouver, rates have jumped from, well, in 2019 they were around 4%, and now they're at nationwide high. So Vancouver, your vacancy rate right now is about 17.9%. And in Toronto, it's 14.8. Oh, wait a minute. I'm sorry. 17.9 is Toronto, 14.8 is Vancouver. Just flip those numbers temporarily for you. So that's really interesting. And a lot of this is that people, they don't want to come back to work. They want to work remotely. And in some places, it's actually better for them to work at home because there's a lot of places don't really need them in the office. And there are some in. Hi, holy cow, Siri. Um, it's one of these funny things, like quite literally. Let me take this off for a second. I don't know if you guys can see this, but she's got a whole big list of stuff here. Oh, I think the thing came up right away. But I taken off the watch. So the watch is not going to talk to us anymore. So yeah, like I said, there's a lot of people who are still working at home, and I know some companies are trying to get people back in, and some people are making compromises like, work 3 days in the office, work 2 days at home. So we'll have to see. Personally, if I ran a business and I was getting the same efficiency out of somebody working at home as I was having them in the office, I would consider sending more people at home and downsizing my office. Although in a lot of cases before the pandemic, we don't know. These people may have signed some very long leases, and that's kind of one of the interesting things. And now let's see here. All right. So Cisco says, what's the difference between CNR versus Canadian Pacific? Well, there's a big difference. The biggest difference here is CNR has a lot more access to Canadians North. So CNR has, you could almost say they have a monopoly over a lot of our natural resource sector and being able to move minerals and critical minerals out of the north. Now, CN also has access to the U.S. going right down to the Gulf of Mexico. However, CP Rail, with the purchase, and now that purchase has gone through of Kansas Southern, they have full access to Canada, the United States, and Mexico. So that's huge. CP is going to be, I think they're both going to be really, really big. Now, CN is actually, I believe it's the second largest railroad in the world, behind Union Pacific out of the States. So there's, some of our railroads are massive. Both, I think, investment-wise, both CP and CN, I think, are going to be great in your portfolio. They're both recession-proof. If you're looking short to midterm, I think you're going to make more off of CN. But if you're looking at long-term, CP, once they have gotten their fundamentals back in order, because when you buy another company, and it does sort of affect your fundamentals a little bit, but I think once that's all settled in with CP, there's going to be some big moves there. Will they catch CN? Will they become, more? Will their market cap ever catch CN? Probably not. But I think there's going to be a lot of growth potential with CP when you look at it for the long term. All right, and Country Auto Garage. Who's the biggest commercial lender in Canada? Oh, that's a really good question. I do not know the answer to that. I can think of a lot of commercial lenders. I mean, just if you think of just the big six banks, as well as some of the different financial groups that are out there. Give me 1 second. I'm going to have a quick shot of coffee. I didn't get a lot of sleep last night, so coffee is my best friend today. And let's see here. Office buildings are almost impossible to convert into apartments. It's more cost effective to wreck them down and build from scratch. That's probably true. I mean, you probably, yeah, because they are kind of built in an interesting way. And that was in response to the friggin' Oracle in the house who was saying convert them into apartments. So it might make sense to just sort of tear them down and rebuild some condos or some apartment buildings, or maybe even some low income housing, just to sort of, cover all of the spectrum. Color stream contracting. Hi, how much money you need to invest to make $500 monthly from dividends? Well, that's a great question. Right now in my TFSA, I have, I think I've got about 75,000, and I pull in dividends wise. I'm probably pulling in just shy of 500, like 400 and something. But here's the big caveat. My portfolio, and if you want to see my portfolio, go grab that link for Blossom, get over there and take a look at it. My portfolio is not geared 100% to dividends. I could get that up a lot higher because I do have a lot of total return stocks in there. I have some good dividend stocks. I've got some of the good cover call ones. I got one of my favorites, Canoe, in there as well. But if I were to rebalance and go with a full passive income at 75,000, I could probably get it up to, I bet you I could get it up to about $800 a month. But that would be it's kind of going against where my investment thing is, because with the total returns, when everything is said and done and the growth comes back, especially going into the bull market, I'll be further ahead on the other side than just with passive income. So that's kind of the reason I go that route. But if you were to fully optimize your portfolio, 10% is reasonable. So a 10% return is definitely reasonable if you fully optimize it. So we're talking about, you're going to go into a lot of cover call ETFs. You could probably do that with about $50,000. But at the same time, there's an extra risk with some of these ETFs, and sometimes there is loss, there is some return on capital. So you want to kind of look at things like, you would want to do this out of a TFSA for sure, because you don't want to have to worry about your just about raw return of capital attacking your average cost base. So you don't want that. You don't want that impacting. And also, if you're fully committed to only having that passive income and you don't really care, like you're not planning to pull anything out, that's another thing as well. So that's going to be, I love this next question. I love this question. Are there any ETFs that are fully Canadian and are synthetic cover calls? As far as I know, Richard, not yet. However, oh gosh, we should almost set up a little, not for money, but just like a friendly poll to see which ETF company will do it first. I would say the two leading contenders would be Hamilton and Purpose. And if I had to bet, I'm going to bet on Purpose. I think Purpose will get there first. But I imagine we're going to start seeing these soon in Canada. Right now, we do have the ones in the US, but I do definitely think you're going to see those ones pop up in Canada. Siri is jealous. Yes, Siri is sometimes. I can't wait. Now, there is I think it's an app that you can download that it will hook up with Siri, and you use the API of ChatGPT, and you can make Siri more intelligent. And then, so I don't know if I want her to be more intelligent, because sometimes I get really amused by some of her random comments that come out of nowhere. And Sammer says if you are looking at dividend using cover calls, you can get 10 to 12% a year. Yeah. So that's the thing. I go in the lower end of that 10%, but yeah, you could even probably get up to 12, maybe even a little bit higher. But you also want to keep in mind that, you need to have a good risk tolerance. I think if you're going to go that route, for me, I look at it this way, that there's no guarantee that, like take HYLD. I mean, it's Hamilton. I feel like, I don't feel like there's any real danger of anything with that ETF, but it has lost a lot of value since I've gotten into it. It's still, pulling out an amazing dividend, but there's nothing to say that they couldn't one day just decide, oh, we can't afford the dividend anymore, turn it off. I don't think that will happen, but there's nothing stopping it from happening. So that's one of those things when we talk about risk tolerance. You have to realize that with dividends, just because a company has a dividend, it doesn't mean that you're guaranteed a dividend. You're never guaranteed your dividend until the company declares it. And, they'll do that with each period. So that's kind of one of those things you have to kind of keep in mind. Does HYLD get taxed in a TFSA? All right. So that's kind of an interesting thing. There's a yes and a no to that. Now, because HYLD does hold, a bunch of American ETFs, there's probably a little bit of withholding tax going on behind the scene on those. But honestly, you don't really notice it. But you're not going to be paying any other taxes like, what is it, 14 cents off of each share that you're getting. That's not going to get taxed by the government at all. You're fine with that. Same thing if you had it in an RRSP or an RESP or an RDSP, anything like that. Can you hold U.S. stocks who pay dividends in your TFSA? Well, yeah, you can, but it's not usually advisable. And I'll tell you why. If you hold a U.S. stock, let's just go with, we'll go with Union Pacific because we mentioned them before. So if you had a Union Pacific and you throw it in your TFSA, you're still going to get their dividend. And they have a half decent dividend. I think it's like, oh my gosh, it could even be as high as 5%. But, and I'm just sort of shooting in the dark right now on that one. But you will lose 15% of that dividend. And that'll go to the IRS as withholding tax. Now, you will not get that back. And the reason you will not get that back is that there's a tax treaty between Canada and the US, but it's only for retirement funds. TFSA is not a retirement fund, but the RRSP is. So if you had Union Pacific sitting in the RRSP, that doesn't become an issue. You're going to, you're not going to be paying that 15% withholding tax because of that tax treaty. If you hold it in your personal or a non-registered account, you'll still lose the 15%, but you can at tax time apply to get that back. Now, you're still going to pay on capital gains. You're also going to still pay the Canadian taxes on those dividends that come in because it's not protected by anything. And where they're not Canadian dividends, you're going to pay a bit more income-wise on it as well. So just keep in mind that even though you get that 15% back by having it in a personal, you're then paying tax on everything else to the Canadian government. So U.S. dividends, if you got them, I usually say throw them in. Throw them into your RRSP because that's a great place to keep them just tax-wise. Now, I held Union Pacific. I've sold out of them for now. I did put them in my TFSA at the time only because I had the funds there and I wanted to hold them, and I wasn't really holding them for the dividends, even though they have half decent dividends. I was looking at them for growth at that point in time. All right, and we got Blondie Viral TV. Hello, Candace. I missed the show. I'm glad to see you again live every single week. I would say in a year, I'll probably miss maybe 2 Sundays out of a year, maybe. So, yeah, definitely am here every single week doing the live thing for you guys. And let's see here. Perovea, have you added any more TOU at its current bargain price? I haven't, but that's only because I think right now it's very close to my 5%. And I try to maintain that 5% limit um, on any one of my stocks. Like right now, I've got a few that are just over 5%. Well, I got one of them is Canoe. Canoe was at 8%. It's now fallen down into the sevens. So I'm glad. I can't wait to see that fall down a little bit further because I do like to keep 5%. And that's just part of that's my diversification mindset. So it's like, yeah, keep everything down to 5% and then I'm happy. Uh, but sure, let me tell you that TOU, Tourmaline, I would love to have more, but for me to buy more, I have to buy more of everything else just to knock it up that way. So, but I do have enough of it that I think when they have their next special dividend, and now they said they were going to do 3 more special dividends this year, but until they're declared, don't count on them. But if we do have the next one, they just did their regular dividend. So the 20, I think it was 25 cents a share, something like that. The next special dividend, if they follow suit, you're probably looking at it in early May. But once again, don't take that with a grain of salt until they declare it, because they said they were going to do 3 before things started tanking a little bit at the beginning of this year. But with the recovery on the table, I think that we're probably still going to see those other 3 special dividends. So I'm still still waiting for those special dividends because, like, I think it was $2 a share last time, and that was great. Hey, Candace, my other son Logan is now watching with us, 4 years old. He asked if he could get a shout out as well. Appreciate it. Hey, Logan, how you doing, my little guy? This is really awesome. And you got a cool name. It's like, I don't know if you know about superheroes, but like the Wolverine guy from the X-Men, his name is Logan. So that's really, really cool. So anyway, great to see you, Logan. Logan, holy cow, your kids are just going to be fantastically good at investing. They're going to have that advantage that the rest of us didn't have, which is great. And that's one of those things they really should be teaching. They should be teaching this stuff in school, but I think a lot of schools are starting to get that now because I have heard of a little bit of some of this economic stuff starting to flow into schools. But I certainly would have loved to have known it because I know when I graduated high school and then then when I went through university, I didn't, taxes, for example, to me, taxes was, oh, you go to H&R Block and they give you your money. That was what taxes were. And knew nothing about investing at that point in time. I think myself as a kid, the only exposure I had to investing is, I think, an episode of Family Ties where Alex went and lost everything on a coffee farm or something because he was pretending to be his dad or something. And I was just like, okay, that sounds pretty darn risky. But yeah. Anyway, I'm glad I know a lot about it now. And I'm glad that, we got communities like this to sort of help people understand about, investing and taxes and all of that fun stuff. All right. Reiko says, whenever I buy covered call ETFs, I do so with the idea that I am buying income, kind of an annuity. If my ETFs grow a lot, I may sell and more beneficial ones. My TFSA brings in $1,250 monthly. Wow, Reiko, that is fantastic. That is really, really good. Cisco says, Torlamine, the dividend is $1.76%. Maybe it is. I don't know. it. Oh, I don't think it was 25 cents. I think I got $25. I think that's what that was. But yeah, that's it's still a pretty good dividend. Let's see here. Country Auto Garage says, holy guacamole, $12.50 per month. That is really, really good. And it sounds to me, Rayco, that you've got yourself very much focused into that income, which is definitely great. And here's the thing, when I'm at the point that I'm going to retire, so at that point, I will probably go into my portfolio and I will gear it 100% into passive income because, especially that TFSA, like that TFSA is going to simply be an income generator when I get to the point where I decide to retire. Now, I don't plan to retire till I'm like, I don't know, maybe 70 something, maybe. I don't know. I mean, I love doing YouTube and I love doing what I do. So I'm going to just keep on doing it. All right, let me get to a little bit more of the news. It's kind of funny. We had a kind of a slow news week, but yet at the same time, well, slow financial news week. But at the same time, yeah, this has been a fantastic chat. You guys are really awesome. So let's see here. So TD has ominously picked up a little bit of a record. And that is they are currently the most shorted bank in the world. Holy banana bread. So basically, and you guys, I don't know if you guys know how short selling works. So basically what happens is a short seller will come along and they'll look at TD and they will say, okay, I think that stock is going to be going down. So let's say TD is $100. And they're thinking, oh, you know what? I bet you that stock is going down. So they will buy, well, they won't actually buy. They'll borrow TD stocks from another third party. So they'll borrow, well, we'll just use one. Let's say they borrow that one stock for $100. They know they have to pay them back that stock. But what they do is they buy it from them from $100 and then they sell it. And they take the $100 in their pocket. Now they wait. And then TD goes down. If they're right, let's say TD goes down to 90 from 100. Well, then at that point, what they do is they buy it back at 90. They give the stock back to the person they borrowed it from. And they've made $10 profit. Now, if you did that with 100,000 stocks or something, you've made some pretty big money. But that's kind of what's happening right now with TD. And a lot of people are thinking TD is going to go down for a couple of reasons. One of them is that, one is their heavy exposure to the housing market. And with the interest rates going up, with a lot of people on the verge of foreclosure, they're thinking that's going to hit TD hard. Another is they have a 10% stake in Charles Schwab, and Charles Schwab is actually really, really, really struggling. So they're thinking that's going to pull them down. And then, of course, they had put in a bid to purchase First Horizon. And First Horizon has really, really suffered. So First Horizon is worth much less than what the bid is. And that's another thing that's going to pull TD down. I can't remember the exact number. I think it was somebody in chat might know it, but there's a significant difference. So that's just kind of one of those interesting little things with TD. All right, now let's see here. And Jill says retire. Yeah, well, that's the thing. I mean, I look at it this way. For me, retirement is when I do retire, I want enough income coming in that it will feel like I haven't retired, but I'm just being very lazy. That's to me what retirement will be. And I probably won't be lazy. I'll probably do something else. But here's the thing. I mean, I like doing YouTube. For me, retirement would be instead of doing, 2 to 3 videos a week and a live stream, I might do 1 video a week in a live stream. That to me would be retirement, right? Because that's the neat little thing with YouTube. I mean, as long as YouTube is still around, we'll keep that in mind. And then, the way I look at like day trading, for example, it'll be a situation that once I've retired, it'll be like, oh, I just need some extra cash for something. I'll go day trade for a couple of days, get that cash, that type of thing. So anyway, that's kind of the way I think about it. But nobody really knows. I mean, I was reading an article about some of the anti-aging science that is starting to make headway. And once AI takes off, and it already has, once we apply AI to stuff like that, it might be a situation where, we're all living and working till we're like 120 or something. So that would be very interesting to see how that would transform the world in that way. All right. Now, Ray Coase says, I retire in 2 years. That's why I focus. Exactly. That's the exact same strategy I was just talking about. Rayco is living the dream. Fantastic. Cisco, Reiko, what is the best ETF that you like? And I'm just going to jump down to Reiko's answer on that. Let's see. EIT, so Canoe, HDIF, HDIV, HMAX, and HYLD. Those are all some fantastic. We got a couple, we got some Hamilton and we got some Horizon ETFs in there. So they're both, both. They're all really good. Oh, and Call. I almost missed Call, CALL. That's in there as well. All right. Now catch up who I missed. I missed Sammer. Let's see how this high income ETF will perform in 10 years. Not enough data now. And that is absolutely true. There is not enough data to see how that is going to all turn out. And Samer's biggest position is HYLD. All right, color stream contracting. What do you think is the magic number / month for retirement? Oh, you know what? That's an individualized question, because some people can live well below their means. And here's what I would do. Like, if I was thinking about retiring, a year before I retired, I would go through a test. I would do a test retirement. I would still work, but I would cut all my expenses down to where they're going to be after I've retired in a year. That way there I could sort of do a test run and see if I can survive off of that. And if I can't, and I do need a little bit more income in the tank, I might then at that point, I might even say, okay, you know what? Well, let's just work one more year. So that way there I can reach that level that I want. But it really comes down to your lifestyle. If you have, if you have a house that's already paid off, you're only paying taxes on that. If you don't have a lot of expenses, then your number is going to be a little bit lower than somebody who perhaps still has a mortgage, and somebody who does have a bit more expenses and doesn't have as much income coming in. So it really boils down to, now I know some people say that you should have $2 million in investments to be able to retire. But it really comes down to, what income you have coming in, how you play them. Even going into retirement, if you're on the lower income side, you can play the OAS GIS game. You can play with that math and try to max that out a bit. And by having, anything extra into that TFSA, that's going to create income that's not going to affect any of the other benefits that are out there. So there's a lot of ways you can sort of handle that. But now the friggin' Oracle here sort of pointed out retirement costs over $1 million a person now from 65 to 87. And that's the whole thing. We don't know how much. Keep in mind too, a lot of people who comfortably just had enough to retire, then the pandemic hit. Some of those people are in trouble right now because they're just not able to retire because all of a sudden they're, they're paying a lot more for different things. So it's very individualized. I would say comfortably, if you want to comfortably retire, I would say you want a bare minimum of about $1 million invested. And that's, when I say comfortable, that's going to take care of things like inflation. And also it's going to be big enough that if there is, if there were another bear market, it shouldn't impact you as much. Especially, with passive income, you should be okay. There are some passive income sources, though, that you have to kind of watch. So, for example, if you looked at a lot of the split fund or, like your split core stocks, a lot of them had some issues around the pandemic. And they, some of them stopped their dividends for a couple of months. So that's kind of one of those things that you need to watch. Now, there are some split core that are fantastic, like ENS was good. BK was fine. So there's a couple out there. But some of the bigger ones like DFN and things like those, they have great dividends, but you're looking at a good amount of return of ROC. So you want those in registered accounts. And they will, when things get rough, they can turn off the dividends for a couple of months. So as long as you're okay with that, that's one of those things that you have to sort of take into consideration. All right, we've got Brian in the house. Hey, all. Do you know a covered call ETF that doesn't leverage and isn't too heavy in financials? Covered call ETF that doesn't use leverage. Well, there's a lot of them that don't use leverage. Um, like most of the covered call ETFs that are out there, like you take even someone like if you go over to like BMO has a whole bunch of covered call ETFs. Most of those are not using leverage. Most, even like things like HDIV, HYLD, they're not using leverage. They're just using options, and they're using that premium that they're getting on those options to pay. So yeah, now once you get into the synthetic ones, those ones are using leverage. There's also some ETFs out there that use leverage as well. So for example, if you look at the inverse ETFs, those inverse ETFs are using leverage, sometimes 2 times, 3 times. So they can be a little bit on the harder side. All right, Montreal. Sorry, Richard from Montreal. Seems like monthly dividends makes more money than quarterly. Well, it seems like it, but um, you'd have to really work out on the math. Now, the advantage to monthly is if you're reinvesting it. And so if you're kind of like doing a drip and you're just dividend reinvesting over and over again, you probably might be able to edge out some quarterly, but there's some really nice quarterlies out there as well. But keep in mind too, a lot of the quarterly ones also tend to be stocks that have growth with them as well. So you're getting that growth in addition to the dividends. All right. AC Dat says, if I had over $1 million at retirement, I'd never have to touch the $1 million. That's the way you want it, right? Like you want to have so much money that you have to figure out who you're going to leave it to. And that's not a bad problem to have. Perloya, Porlovia. I got very little sleep last night, so if I crucify anybody's name, please forgive me. See, good answer. It's all about your choice of living. Live the high life, you'll need a lot. And to many people, high life is rated in many different ways. Absolutely. And here's another thing too. You can downsize. So if you had a big house because you had a big family, and well, once you're in your golden years, you may not have all of those people, there all the time. You may not need as big of a house. And if you've lived in that house your whole life and you decide to sell it because that's your primary residence, that's beautiful because that's not going to count against your like your GIS, for example, or your OAS, because that's going to be considered non-taxable income. But what you do with that income, that if you throw that just into a non-registered account, then everything it makes is going to be taxable. So what you would want to do, of course, is if you have room in your TFSA, you would certainly look at putting it in there. But you have to have lived in it while you've owned that house. So it has to be a primary residence. If it's not a primary residence and you sell it, there will be, depending on if you've lived in it partially, there will be taxing involved around it, and it could impact any kind of old age or security supports that you do have. So that's just one of those things to keep in mind. All right. Where was I at? I think I'm at Rayco. I live frugally. My car has 637,000 kilometers. I will drive that thing until the wheels fall off. Living frugally is important. Is an opportunity to invest. Absolutely. Absolutely. It's one of those things. I mean, I love my phone. It's an iPhone 11. It still works perfectly. Although there's a part of me, the geek part of me, that's like, I want a newer one. But that's how you lose money, is by, if you have to have the brand new one every time the brand new one comes out, that's a recipe for being broke. So you kind of want to get as much out of anything that you can, because all that extra money you're saving, you put that into your TFSA, you let that start snowballing, and it'll make your retirement that much sweeter. Okay. Let's see here. Inverse ETFs, like which ones? Well, there's a lot of different inverse ETFs. So for example, there's a Bitcoin inverse ETF. I think it's called BITI. And when Bitcoin goes down, that ETF goes up. There's an inverse oil, which is HOD. So when oil's going down, that one's going up. There's actually There's actually, and this is funny, there is a Jim Cramer inverse ETF. So basically, every stock that Jim Cramer recommends, this ETF pretty much bets against it. So when Jim Cramer's wrong, you make money, which is, you're probably making a lot of money with that one. Uh, Sorry, Jim Cramer. I don't think you're watching this, but hey, you never know. Um, Thanks, Reiko. All right. Oh, and by the way, Richard, I did do. There is actually, I think there's some listed. There's an inverse ETF video on the channel. If you just search for it, that'll give you a few more ideas as well. All right, and why? Oh, I am a new immigrant to Canada, in debt now. Started investing in the bear market. No house, but planning to house and almost close. All right, and almost close, 50. What would you suggest? Rent or buy a house? All right. Right now, I would not buy a house. And that's because we're looking at the rates being high. I do see rate cuts coming in the future. A lot of people actually believe we're going to see rate cuts before the end of the year. So I don't think 2023 is the best time to buy. I would look maybe into 2024. Now, renting is another struggle because there is such a low vacancy rate. So this is a landlord's market. They are able to, they're charging rents are really high right now. But when you look at it this way, pay a high rent for a year, but get a much better mortgage on a house that you purchase down the road. Um, that's probably much more desirable than just jumping into the housing market immediately and and getting ending up with a mortgage much higher than what you would preferably like to have. And also, housing prices are starting to edge down. So hopefully that trend continues through the year as well. Pay attention to it. Always do the math. Work out. All right, how much am I paying for rent? You know, um, and how much of a rate increase, or how much is the rates coming down? How much is the housing prices coming down? Uh, that's that thing. Now, here's the beautiful thing though. If you're like 100% sure, like, okay, I'm not going to buy a house for a year, and you've just got that cash sitting there, you may not want to invest it because you may be thinking, okay, well, I can't take any chances on this because I need that, I need that money, my down payment. But you could do something like you could lock it into like a 1-year GIC. Right now, you get about a 5% return on those. That would be better than getting absolutely nothing. So just keep that in mind. If you got more questions, bring them to the chat, bring them to the channel. We'll do whatever we can to try to get that all sorted away. All right, let's see here. I'm only paying 21 bucks per month for a 14. I buy it out for 280, then sell it for 450. All right, I don't know exactly what you're buying, but that sounds like a good deal. All right, I would never invest before paying off debt. You make more by focusing on paying off high interest rates debt first. Absolutely, Reiko. That is a perfect example of how to do it. So here's the thing. Dave Ramsey has his snowball method, or his avalanche method of paying off debt. So what Dave Ramsey will say to you is he will say, all right, take your debts, sort them out, and pay off the lowest debt first. And when I say the lowest, as in like if you have one debt that's only a couple $1,000s and everything else is much higher. And the reason he does that is because it'll give you that psychological boost. Because all of a sudden, instead of having 5 debts, you've got 4 because you paid one completely off. I get that, but here's the thing. I'm very mathematical. If your smallest debt has 5% interest on it, and you've got a big wonkin debt that has 20% interest on it, well, to me, I would rather be paying on that 20% because, everything I'm paying off of that principal is saving me a lot more money than paying off that little debt. But, and this is why I usually will recommend this as kind of the final solution, is if you are that person, if you absolutely need that psychological boost, if you feel like it's overwhelming and you're not getting anywhere, then maybe go in, quickly pay off that little one, but then go straight back to that highest interest one after that and try to get that down. The other thing too is look and see if you can consolidate that. Because if you can get a line of credit, or if you can get somebody who will consolidate, all under one roof at a slightly lower interest rate, you're in better shape by doing it that way. So just keep that in mind. All right. You're welcome. Why? That's what the channel is here for. All right. I got some statistics for you guys. So the Angus Reid came out with a little bit of a survey, and they are basically They're basically surveying people in regards to how they're handling their savings during these tough economic times. 40% of the people who were surveyed said that they've actually started dipping into their savings. Like, when we're talking their savings, these are savings that they said that they would never be using. They were totally to be saved, whether for retirement or something like that. So 40% of Canadians appear to be dipping into their savings, and it's sad that that's happening, but with inflation, higher cost of living, some people don't have that choice. Now, 35% said they are deferring their TFSA and RRSP contributions because they can't afford it. 13% said they had to borrow money from friends and families just to make ends meet. 11% said they had to take out a bank loan. And 8% actually had to start selling off some of their assets just to make ends meet. Wow. I would love to see these rates start coming down a little bit. See people get a bit of a break when it comes to everything, inflation, these interest rates, because it's the world is a lot different now. It's to the point where if you were to go all the way back to the 1950s, you could have one person in the house going and working a full-time job, and that would be enough to pay for everything. Your car, your house, get your kids into college, all of it. So now we're at a point where you have a two-parent household, and they're both working full-time, and then they're still struggling to make ends meet. So it shows how far we've fallen from where we once were. All right. Now, another thing came out this week. There was the JOLTS. That's the jobless, or not jobless, but the job openings report in the U.S. So one positive thing about that is that the JOLTS actually fell for the first time in about 2 months. It fell below 10 million job openings. They're now down to 9.93 million job openings down there. Now, they have the CPI coming out on Wednesday as well. So that's going to really come in and play on what they're going to do with the next rate hike down in the U.S. So that's going to be interesting. All right. And I got one last story, and this is kind of a fun little story. Well, no, it's not even fun. I just want to say, it's just that I wrote the title in the Navy. So the Canadian Navy is doing something different. The Canadian Navy is offering a 1-year trial subscription, so to speak, to the Navy. So how does that work? In the past, if you joined the Navy, you're in for 3 years, basic training, and you get deployed and all of that fun stuff. But they're having a big crunch. So the overall Canadian military is down 12,000 troops. So they have 12,000 troops they need to fill. The Navy has about a 17% vacancy rate. So what the Navy is saying is, hey, come on in. Give us a try for 1 year. It's a trial. It's a trial program. At the end of that year, if you don't like the Navy, you can go away. You can just go and, live your life, or you can stick around if you like it, and we'll make sure you have a great career. So that's kind of where where the Navy is going. So that's kind of really, really, really interesting. All right, and I'm going to jump back to chat in just 1 second. Next week, these are the things that are going on in Canada. On Wednesday, we got the Bank of Canada rate hike decision. And everybody's thinking they're going to stay the course and not raise the rates any further. In the U.S., we got 3 different reports coming out that could certainly impact the market. The big one, of course, on Wednesday is CPI. We'll get to see whether that consumer price index is showing reflections, showing inflation coming back. The second is the PPI. That's coming out on Thursday. That's the producer price index. So that's basically the people behind the scenes who produce the goods and services. And on Friday, the U.S. retail sales are coming out. We'll get to see how badly those have been impacted by all of the less amount of money that's out there. All right, I'm back to chats, folks. I'm back here. All right, let's get over here. And we got Wayne Smith. I can remember a time when there were no credit cards. Holy banana bread, Wayne. I can't remember a time without credit cards. I can remember when there wasn't any debit cards, but I can't remember when there weren't any credit cards. Oh, but that's kind of awesome. I know I do remember with the credit cards when they used to do that thing where the carbon paper and it was like that was kind of cool. But yeah, I remember that. And actually, just a second here. We'll get to you in a second, Siso. And here's one of the funny things. The way credit cards used to be is usually once a week, the credit card companies would send out a list. So you get this little list of all these card numbers if you're a retailer to say, these are the people who don't have room left on their credit card. So you could almost blow past your limit without any problems. As long as you're buying smaller things, like if you bought something big enough, they'd have to call in to get authorization. But you used to be able to do that because it was just a simple carbon copy thing. So I don't know if I would like it that way anymore because it's nice to know that if you don't have the money, you shouldn't be able to buy something. So that's the way I look at it. All right. And Cisco says, Candace or anyone in chat, if you had $125,000, how would you invest it today in today's market? I don't need the money for now. All right, so $125,000. I know myself, I'm going to diversify it. Problem is, there's no room to put it in my TFSA. If I put it in my RRSP, then it turns into income when it comes out. So, and even if I qualified for the new house first home savings account, I would only be able to put in 8,000. So that's a really good question. What would I do with $125,000? I'm probably, let's see, if I have to use it in my personal account, and I just don't need to use it, I'd probably go in that case, because I'm assuming you want that money back. So my big concern is that I don't want anything that's going to be having any kind of a deterioration in value. I want something that is going to grow a little bit. So I would probably be looking at total return stocks for that. That's what I would do. And some of the safer ones. So I'm going to forego the really big dividends, but I'm going to look for stocks that have good growth potential, moderate sized dividends. And that's where I would put it, because that way there, when I do want that money back, I will, first of all, I'll have capital gains. Sure, that's fine. I'm going to be paying on that, but I'm going to have made enough growth that, I'll still be able to pay the capital gains and plus whatever taxes I have on the dividends. So that shouldn't be too much of an issue. That's what I would do, I think. Now, if I did have an empty TFSA, I would certainly max that out first before going into the personal, but that's what I would do. All right. Richard says, went to the Credit Counseling Society to pay my loans, and they charged me 0 interest on my debt for $40 fee a month. I'm saving money. I can now invest. That's fantastic. Sorry, I was going to say fantastic again. That's actually really good. That's a good idea. And that's the thing. There are resources out there. So here's that thing. A lot of people, when they get into debt, they panic and they do all the wrong things. The thing is, if you don't have the money to pay your debts, the very least you want to at least be contacting and talking with the creditors, or in the case here, like talking to somebody like the Credit Counseling Society, and looking at every option available to you. Because, dear Banana Bread, if you guys absolutely tank your credit, you're getting a long fight to get that back. And credit's kind of important. Nowadays, you go to rent an apartment, they run your credit report. So, I've seen people turn down from an apartment because, they had a couple bad things on their credit. Not that I had no doubt that they could pay their rent. But you know, the rules were the rules and we weren't allowed to rent to them because of that credit report. So it's one of those things. Let's see. The first card was the Diners card. Ah, the good old diner. I've heard reference to the Diners card. I've never actually seen one, but I remember people actually probably the references I've heard is people making jokes about their Diners card, but no, that's really cool, Wayne. That's very, very cool. So I would buy agricultural land and rent it out to farmers who need the planting space. That's an interesting idea. Um, yeah, why not? I would, of course, make sure that you buy the agricultural. If you're going to go with Jordan's idea, make sure you're buying it in an area where you've already sussed out that you've got a market for it. You know, because the last thing you want is to be stuck with some agricultural land and nobody who wants to rent it. Here we go. Cisco says thanks. And Mr. Red Taco is in the house. I remember my first debit was 25 years ago, and it was for a pack of gum. Let me guess. It was Hubba Bubba, wasn't it? Tell me I'm right. Hubba Bubba. I don't even know if they make Hubba Bubba anymore, but I remember as a kid, we used to love getting Hubba Bubba because it's one of those words that when you say it, it's kind of fun. So Hubba Bubba. That was kind of neat. Wow. All right. So let me know, Mr. Red Taco. Was it Hubba Bubba? All right. Awesome. All right. We're coming towards the end, guys. If you got any last minute questions, throw them in really quickly. And we'll pound those out. Call it lightning round. Bang, bang, bang. Give me some fast questions here. So, I think so. I was barely legal to drive. Yes. Well, and nowadays our cars can almost drive for us, which is kind of cool. While we're just sort of petering things out here, tomorrow's video, it's a different type of list. I had a few requests for people saying, you know what, they're like, what's this EPS thing and why is it important? And you know, because you always talk about EPS and PE ratio and all of that. So I did a breakdown. I took 6 of the surface data fundamentals and just broke down how you calculate them, what they are, what they mean. So that's coming out tomorrow. So that's going to be kind of for some of you, you'll be like, oh yeah, I know all this. That's cool. But for those who don't know about it that much, then that's going to be there for them. All right. Oh, we got a question here. What do you think about Ensign Energy stock? That's a really good question. Let me pull them up and take a look at them. Boop-a-doo. And, you know what I can do? Just give me a second here. I can... I'm going to add an item to the screen here. They just added this new function. So I'm going to add an item. And now I am going to... I just need to find the screen. I'm going to share a screen, and we'll share a window. And which one do I want? This one here. All right, here we go. Now I'll bring this over here. I'm going to drag this over here. All right. Oh, and I can make this here bigger. There we go. And I need to go to my... All right, so there's a couple places I will go when I'm looking at a stock. So this one here is Ensign. There we go. So Ensign Energy Systems right here. All right, so 293. So they're down there a little bit. First thing I'm going to do is I'm going to quickly take an overall look and see what they have done. Ooh, banana bread. Let's see here. This is the 5-year. So they came down a bit, but they've been doing okay the last... Let's just switch this over to 3-year. So 3-year, they've been doing a lot better. But keep in mind, oil has been doing well. So they've been rebounding with that oil. Just going to come down here and take a look. All right, so they're not a dividend stock. They've got an EPS of 0.05. All right, I want to, and I'm going to come back up here, and I'm going to go to key data. Now, this site, by the way, this is TMX Money. It's a great site if you have never used it before. Now, all right. So I'm going to come down here, and I'm going to look at a few things. So beta, So their beta is 3. That means that they're going to be very volatile. Basically, a beta of 1 is the market average in volatility. So this is going to be 3 times as volatile. So this might be a good stock to day trade, maybe, because it's going to be moving quite a bit. So, but here's a few things I want to take a look at. I want to look at the return on equity. So here's return on equity down here. And it's at 0.63%, a little bit low. I like to see that a little bit higher, but it's not in the negative, so that is good. All right. And they, like I said, they don't have dividends. And let's see, what is their market cap? Their market cap here, 540 million. That's not too bad. I think this might be one. It's definitely a good looking little growth stock. I think as long as oil is doing well, this might be one that I would, I would be okay with it. But if oil starts to falter, it's one I would keep an eye on it. Just gonna put that down there like that. And actually, here, let's move this in behind. So this is just a new little thing that they just added to StreamYard that I can now do. So that's kind of a neat little thing. Oh. Okay, sorry about that. It's just like I hit the wrong button and it booted me out for a second. I had to boot myself right back in. Holy banana bread. All right. So yeah, Ensign Energy stock does look like it has some growth potential. I would just pay attention to it when oil is not moving up because of that volatility that's in there. But it's perhaps not a bad idea to put a little bit in there and see what happens. So, keep that in mind. All right. Yeah, hit the like button. If you guys have not hit that like button, just give it a smash, turn it blue. It's like opening an Easter egg, but you don't get the chocolate inside. You just get algorithm stuff, something like that. Happy Easter, everybody, says Country Auto George. Loving the share screen. Yeah, I'm trying to find other things that I can do. I want to be able to just pull more stuff into the stream. So it's one of these things. I'm always trying to improve things. So I'm looking to add a little bit more bedazzle, but not like the one that makes like studdy things, like those funky studdy shiny things that make you look like a punk rocker, but who's really bright. So thank you. Love this channel. Broke down current events and easy talk about security. Simple and to the point. I'll eat the banana bread if it is a vegan version. You know what? For you, I will make vegan version banana bread. And you lost me to the stars. No, I'm back. I'm back. And Bonnie's in the house. Happy Easter, everyone. And hello, all. Hello, everybody. This has been a really good stream. So coming up on the channel this week, I mentioned about the tools that we're going to do on Monday's video. Thursday's video, I did that poll last week to see what deep dives you guys did, and Canadian Natural Resources came in first, but Nutrien came in a close second, and I had a lot of people saying, please, please, please do Nutrien. So we're going to do a deep dive on Nutrien. Then we do have a Saturday video. Actually, it's the channel member video. So those of you who are channel members, there is a video that will be coming out. There's still a vote going on. If you are a channel member, by the way, and you have not yet voted on which video you want me to make, you've got a couple of days to get that done. So just when you go to the channel in YouTube, if you don't know how to find the place where you vote, up at the top, there's a thing that says membership. You just click on that and you'll see the poll right there. Definitely click on that. So right now we have 2 things winning. One is how much money do I make on YouTube? If that one wins, you'll get to see all the analytics, and I'll just go right behind the scene. We'll peel back the onion, show you everything. The other one is Vanguard ETFs. So I'm like, okay, sure. If that's what you guys want, that's what we'll get. Any of you guys who are interested in having exclusive extra content, once again, just join the channel membership. It's like It's less than the price of a coffee a month. And you get an extra video every month. You also get to see all kinds of trades. And I also do a dividend summary for you. And, you know, we're going to keep working on that because I really, really want to make that membership experience. I want to make sure that it's worth the $2.99 plus tax that you're paying for it. So, you know, we're just going to keep on doing that. So anyway, I also give away free memberships every month. Every month, I usually towards the end of the month, I'll usually drop a few of them in here, just because that way there it gives people a chance just to get a taste of what the membership is like. And hey, and plus you get the, you get that nice little, you get the color in here. And so, that's kind of a nice little thing. Anyway, that's what's coming up this week. I do have another Saturday video, though, coming up the week after. I know that's a long ways off, but somebody had asked me to do a video on the hc.ne. That's what Kendall's talking about. Just give me 1 second, Kendall. Somebody wants me to do a video on the RESP. So we're going to do a video on RESP. hc.ne. All right. Is that on the Neon Exchange? Let's take a look. Or the Neo, sorry. Neo. I want to call it Neon. All right. I'm just going to pull this. Let me pull that screen back up here again. Boop-a-doo-doo-doo. Here we go. All right. There we go. We'll brought that back up, and hc.ne. Let's take a gander. hc.ne. Pull that in. Let's take a look here. All right. So this is your Hypercharge Networks. Let's take a look at this. Technically a penny stock is under $1, but when you're at about 265, it's like you're adjacent to a penny stock. But I'm going to start off. I usually start off and just take a look at the 5-year. Okay, so these guys have not been around for a while. Look at this. All right, they've been around since 2022. So let's go to that 3-year, and we'll see it a little bit better. Let's actually go to the 1 year on this. Okay, so let's take a look here. Oh, this is very, very interesting. So something happened. They had a pretty big explosion. Oh, so they're new. Yeah. Let's see here. No dividend. So they've got a negative PE ratio, and they've also got a negative earnings per share. So right now they are losing money, but that's not that abnormal for a brand new stock. Let's see here. What do these guys do? Okay, they're an electric vehicle supply company. All right. Turnkey electrical charging solutions. Okay. So they're supplying the EV market. That's good. I'm just going to come in here. I'm going to go into the key data. We'll just take a look and see. Right now, they don't have a lot of key data. Now their return on equity right now, holy banana bread, negative 147.50%. Hey, that concerns me a little bit. That does concern me. Now, here's the thing. When I see stuff like this, I'm going to want to do extra research before I even consider investing in a company of this nature, because there's enough red flags. There's a lot of red flags here. Now, here's something that what Kendall is saying is, here we have a situation where they're going to be providing parts for EV charging stations. And there's a lot in the news right now about setting up EV charging stations. I've heard about Walmart planning to set up a whole bunch of them around their stores. So there's a big push on that. So this is a stock that I wouldn't jump into, but I would certainly do the research on it. And I would want to kind of get an idea if this company has any commitments at all from anybody. So if anybody is already at the point that they're like, okay, well, we're going to buy all of our parts from you type idea, because that to me, it just makes sense. So I want to always be common. And in a case like this, even something like this, here's the problem with some of these stocks that are small is if there's like about 5 of them, maybe one of them actually takes off. and succeeds when 4 may not. So you want to be careful. You want to definitely you don't want to put all your eggs in any one basket because and it's easy. It's funny because here's one of the things. Like when I do a lot of deep dives, like I'll look at some of the oil stocks, like when I'm doing a list, and you'll look and you'll be like, oh my God, look at this stock. It's grown 300% over the last 3 years. But here's the thing. It was a little stock 3 years ago, and there was probably 10 other of those little stocks there 3 years ago that didn't make it. But that one did. And after the fact, it makes it so easy. You can sort of say, oh, I should have just bought that one. But, nobody would know. It's kind of one of those things. So sometimes with the smaller stocks, especially very micro cap type stocks, it can be a little bit of a gamble. So you want to be very cautious. You want to make sure that definitely don't put in anything that you cannot afford to lose because there is that possibility. But do your research. Do your research on this one big time. All right. Cisco says, Come Sense Investing just covered it, pump and dump. Could this look like a pump and dump? Well, it could. But who is doing it? That's the thing. So if it's a pump and dump, or if you suspect, or if you see something like this, in doing the research, for example, if you do a search on the stock on YouTube and all of a sudden you find a big YouTuber telling you it's the best thing since sliced cheese, then yeah, I would be like, okay, this may be a pump and dump. But I have seen patterns like this where it's not so clear because normally with a pump and dump, and let's go back here. I want to show you guys this. Normally with a pump and dump, what you see is, and I'm going to come back to, I'm just going to do the 6 month here. You do see the big going up like this. And let's see, let's take a look on that date. So that was 4/6. Yeah, you're right. You know what? This could still be a pump and dump, but you'll know within a couple of days. Because if this is a pump and dump, you're going to see the big crash on Monday, because that would have been when whoever pumped it is basically selling it because, they're getting everybody to buy in at this point. And down here, you can see these little bars down here are the volume. So down at the bottom, you can see the volume there. Now, the volume doesn't look like a typical pump and dump per se. So chances are, and you can go to there's other browsers as well, other viewers. Like which one do I like? Like Trading View is really good. So that's one that I'm gonna just pull me back in. That is a good one to look at to see whether it is a pump and dump. But yeah, I would follow Cisco. Ciso. Why do I always want to throw a C in there? I don't know why, Ciso. I'm so sorry. But no, I agree. I would not buy it. But if you really, really do want to buy it, then do your research. Absolutely. All right, guys. We're at almost an hour and 30 minutes, so we've come to the end. But all right, why come back here next week and throw up the INVRS again, and we'll take a good look at it for you next week. Only because I'm getting hungry here, and I'm also really tired because I only got a few hours sleep last night. So we're coming to the end here, guys. I just want to thank you guys all for being here. You guys are awesome. And look at this. Scott sneaks in at the last second. Scott over on Create, Save, Invest, another big contributor to the channel. He's pretty awesome. He does his own live stream every single market day. And his live stream starts at 11 o'clock Eastern Standard Time, or I think it's, 9 o'clock Pacific Time, because Scott is coming from the West Coast. Anyway, check him out. Throw him a sub. Throw him a follow. We'll see you guys again here next week. It's going to be a fantastic. And as well, reach out to me on Blossom. That link is down below, and we'll chat there. Anyway, it's been fun. Take care. Have a happy Easter, everybody. And we'll be back here to do this again next week. Bye.